So funny how it always cuts us off when we're in the middle of conversation when that thing begins. But let's talk about something important right away because my wife and I have been arguing today. She thinks my hair's too short already. I think I look like a hippie, and I'm going to get a crew cut tonight.
Crop
Old guys like us like to have short hair. It's better, right?
I was talking to Jonathan Farrow from Bloomberg a couple of years ago in New York. Only thing him and I have in common is the vowel at the end of the last name. But he's a really good guy in person. And he looked at me and he goes, "Why do you Americans hold on to the hair? Just get rid of it." I'm like,
I agree with it.
Is that what you're saying? Saying I'm losing it?
And the answer to that is yes.
Why do they always try to be so superior? Hey, I got a question for you.
Shoot.
Does today's move in the S&P or any of the equities matter to you at all? Because it doesn't to me when I look at the volume.
Yeah, it doesn't matter. I notice the volume being poor, and I need that settlement above 4420, which is what we talked about on the Futures Edge podcast yesterday with Mike Arnold. And my level had been like 430 before I talked to him, and he convinced me it's 442. Until we can get a settle above it, I think it's just noise. I think it's wild, the V-shaped explosive move higher, though. You don't see quite a move that explosive. I mean, what does that mean to you?
Well, the thing that bothers me about it means to me that I'm bullish, and I am bullish right now. But the thing that bothers me about it, I don't have a position. I'm not that bullish. But the thing that bothers me about it is the last 5 days are declining volume in the futures. All 5 of these days, declining volumes. And if you go back to the sell-off of October 26th, that was the highest volume day I'm actually going to measure it and tell you exactly. It was the highest volume day in like the last 12 sessions. And since then, you can draw a downward sloping trend line on volume. Now, I don't put as much into volume as other people do. I just think that there's going to, in my opinion, on the bullish side of me, there's likely to be a pretty sharp move higher with volume coming up after maybe a day or two downdraft. And that would literally play into the way I want to play this. So
and then if we get that, if that move has a settle above 442, 4420, then we continue it. Okay. Speaking of good hair, I just glimpsed him in the waiting room before. We're bringing on Will De Cottis, who's the CEO of Spectacles. He's going to be a fun guy to talk to, has expertise in a lot of different things, and we're going to hopefully try to touch on all of them. So without further ado, which I don't know what ado means, let's bring in Will De Cottis.
I just don't even look at it.
Look at what? Oh, the picture.
Yeah, I don't even look at it. It's
You should.
Totally incorrect.
It's me on top. Will, do you have any serious hair opinions before we start? My wife and I have been arguing. She says it's too short. I say it's too long. I want to have hair like Bobby's or yours. What are your thoughts on hair?
I feel like after a certain age, everyone knows their buzzer number, right? You're like a number 3 or a number 2.
Yeah.
When you go to the barber, right? But I'll tell you, I like that intro. I'm going to lock that in from now on. From now on, everyone has introduced me as having good hair. I love that.
You do have good hair. You have solid hair. By the way, so now the ground rules. If you are on a podcast with Bobby and I, and we are asking questions of a topic you don't want to talk about, tell us we're dumbasses and we're asking the wrong questions. And what you really want to talk about is B. We have no feelings. We've both worked on trading floors for most of our lives. So if you want it to get rough and tumble, we love that. Are you good with that?
Yeah, sounds great, man. I'm always good to go rogue, so no worries there. I'm not.
Oh, fantastic. Okay, good. We're on the same page. So in the little preview of the show, we were talking about one of the biggest concerns I have is commercial banks, problems within commercial banking. Commercial property, problems within commercial property and lending, and the problems that banks may have holding these notes and paper. Can you talk to that a little bit?
Yeah, I'm happy to. So I guess when you think about this, it helps to back up a little bit and think about kind of the regulatory structure that's kind of gone in since the global financial crisis. And since the global financial crisis, you kind of have 2 sets of banks, really 3. And if you think of traditional banking and really like the big banks, the ones you probably know and can think of, like Citigroup or JP Morgan, these big guys, they exist in sort of a different world than when you think of like your regional banking or the shadow banking system, which is kind of this offshoot that has grown out of banking regulations. And so it helps, I think, to contextualize it. And when you say to yourself, like, oh, I'm worried about banking, what banks are you actually worried about? Because I think that changes the conversation a little bit. And so when you bring up commercial real estate, I think that's obviously a good place to look. That's something that's come up a lot recently. You kind of see the markdowns coming. It's like 70% markdown on top tier assets. You start saying to yourself, who has these exposures? Where does that go? And I think for a lot of the system, it backs up into regionals who have kind of filled the void that was created in risk taking after the global financial crisis. Because basically these large banks, the what we call the systemically important financial institution, the SIFIs, they're not allowed to take those risks. If they take those risks, their balance sheets are risk weighted. And so they're kind of forced out of the market by the way of it just being too expensive, because they have to offset if they take risks of that size with tier one capital or more liquid capital. And so they stay out of those markets basically because it's not economic for them to. And it's sort of like in chemistry, like the conservation of energy. Risk doesn't get destroyed when you regulate it that tightly. It just sort of moves someplace else. And I think practically speaking, that's really what's happened. And so you see that in commercial. There's other vulnerable markets, but if you think of commercial real estate, that's kind of an example that's on everyone's mind, right? Because you can see the buildings getting marked down. You can see across their capital structure, equity levels getting wiped out, the mezzanine levels getting wiped out. You're taking markdowns on loans up the capital stack. And you just logically ask, well, who's taking this loss? Who's making this write down? Who's taking this write down? And so when you think about the regional banking sector, you say, now I'm starting to get a little bit worried about the stability of the system. Yeah.
Two kind of quick follow-up questions. When you look at the top 10 banks and the rumors are talked about, again, I don't talk about individual stocks, but I am talking about individual banks. It's a different thing. My lawyers should listen to that. So you look at B of A and you hear that perhaps they have however many billions of dollars of losses in their hold to maturity corral with their treasuries. But then it always kind of dawns on me, the biggest 10 banks are not going out of business. They're the new word I learned, SIFIs, and Janet Yellen has told us that they are systemically important. And if you are not systemically important, you are shit out of luck. She said that in front of Congress. So do you agree with me that those banks are protected? And if they didn't have that federal government backstop, some of those share prices could be trading a lot lower? And then go off into what sort of regional banks? Do you have any names that you look at that are someone's on your watch list?
Yeah, sure. So I guess to take that question kind of in parts. So I think you can kind of expect that the SIFIs are really kind of embraced by the Federal Reserve and the U.S. Treasury. They're not going to be allowed to fail, in my view. However, that doesn't mean they don't have problems. And so, when you say they're holding on their balance sheets to a bunch of losses, the reason for that is perhaps not a credit risk, perhaps. It's really more a function of the yield curve. And so, as your viewers will know, the Fed has just kind of ripped rates really, really high, and they've basically inverted the curve in a very deep way, a dramatic way. And banks are functionally in the business of borrowing short and lending long. That's what they do. And so inevitably they're going to have this, a duration trade that is not completely underwater. And so when you look at the big banks, they can't avoid that either, right? Because they're still banks, even though they're enormous and protected by the Fed. And so on their books, they're still going to look bad, right? Because you're looking at them, and you're saying, well, this entire book is underwater, and that's just a function of, it's an inverted environment. So that's the one thing. When you're looking at, that doesn't mean there's not bad credits on their books, but it kind of goes back to our larger conversation, is that for the most part, I think the larger banks just weren't able to lend to riskier credits just by regulation. They're just kind of not allowed to, is my view. And so when you look out at like the regional, so, you mentioned, is there any name I look at? I mean, you can just look at kind of at the ETF, like you look at KRE. It's been down, I think, like 30% year to date, something like that. It was kind of going the drain, really. And, when you look at that and you open up some of those balance sheets, you can pick your favorite regional bank. You start to look at them and you say, well, it kind of goes back to our conversation on commercial real estate. You look back and you say, well, I'm looking at a commercial real estate book and I don't really trust that it's marked correctly and I have to write it down. Am I concerned that there's going to be a depository flight if I have to mark this book down because there's just really no assets on this book, or these assets are toxic or the like? Right. And so I think when you think of it that way, you're kind of it's almost like a detective novel or something. You're just kind of following the money through the system. You start to say to yourself, well, if I follow the money long enough, where do these risks really end up? And I think they end up in the regionals, and you got to go balance sheet by balance sheet and look who's kind of doing the worst. And
but you don't have to with the ETF. That's one of the beauties
with
of it.
ETF, you can just look at them all and see it as a basket.
Right.
And I think as an industry, I think they're all suffering sort of together. And I think what that actually creates a risk of, which is counterintuitive, is that those deposits have to go somewhere, and you saw that a little bit with SVB, and I guess First Republic. And so when those two went under, there's basically a depository flight, and Janet Yellen comes out and she basically says, "Listen, SIFIs aren't going to fail, but regional banking, there's only so much we can do. They're going to be wound up or whatever." And so the logical reaction, if you're a depositor of one of those banks, just pull your funds, right? You're just not going to stay in a bank that has the risk of failure, and you're going to flood over to what I'm calling a traditional bank, but I really mean by that is the SIFI, or someone who's protected by the Fed or ring fenced by the Fed. And when you do that, you can actually create a problem for those bigger banks from like a profitability standpoint, right? Because now they're flush with deposits. Maybe they're in an environment where they can't lend or they can't take risks that are available in the market. So now they're just sitting on, big capital base, and they can't do anything about it. And you heard some complaints from that out of some of the bigger bank heads, where they say, you got to release some of these regulations so that we can on lend, because otherwise, like, we're just, you're just getting stuff full of deposits we don't even want. Like, I think during SVB, some of them, they actually tried to turn some away, which is just a crazy thing if you think about a bank saying, like, we don't want deposits yet. But it's a risk. It's a risk to the system.
So, Will, I had a long and complicated question, but I'm going to switch it up to just Janet Yellen called these regional banks not SIFIs, right? Not systematically important financial institutions. Do you think they are economically, market-wise? I'm not talking about damage to the economic or the financial structure. I'm talking about economically from a macro view. Do you think regional banks are important?
I think they're important. I think to the Fed, what's important is changing. And it kind of relates to kind of the shadow banking conversation we can perhaps have if you guys are interested in that topic. But, essentially the Fed and the Treasury kind of have to draw the line somewhere, I think. And when they're thinking about this, their job is really like Treasury market function, banking regulations, and money markets. And that's kind of where they draw the line. And so I think in some regard, they're just trying to find where like the happy medium is of like what they need to protect and what they don't. And I think to some extent, market participants are saying, well, everything's systemically important. And you saw that with SVB. Like SVB starts to fail and everyone's like, oh, if venture capital fails, it's the end of the world. There's no innovation ever again. Everyone starts freaking out. And so the Fed sort of I guess the Fed really steps in with a new facility in that scenario. When you do that, it's implicitly a message that, everyone is deserving of a bailout. And I think the Fed and Treasury are a little fed up with that mentality, is my personal view. And they're starting to draw a line in the sand. And I think in a way, Janet Yellen is doing that, right? She's saying, listen, we're not going to save every regional bank. If you take bad risks on commercial real estate, you're a bank and you're responsible for it. But when you say that and you're meanwhile protecting a bunch of SIFIs, it's sort of like it's almost like a little tongue in cheek, right? Because they will protect you if you're big enough. But if you're too small, you're not important enough to be protected, right? And you're really picking who the winners and losers are. So on one hand, she's saying, like, we're not going to protect everyone. You guys are banks. You need to deal with it. Like, figure out your own stuff. If you get wound up, you get wound up. And on the other side, they're saying, but not if you're one of the top 10, top tier banks. In that case, like, God forbid anything should happen to you, right? We'll like throw the taxpayer out the window to save you, essentially. So, it's a little bit of a double-edged sword there, I think. And so in effect, I think they're in a way, they're picking winners and losers. And I think what's interesting to me, I'll just run down this rabbit hole before because it looks like Bob's got a question. But there's in the shadow banking space, I think something similar has happened. I saw a few days ago, basically the Financial Stability Oversight Council, they call them FSOC. They basically just kind of rolled back a rule that prevented them from designating non-banks as SIFIs, which presumably means there are non-banks that they think will be needing a designation of SIFIs. And so I think essentially what that's a message of is that they're aware of the fact that there are risks in regionals and non-banks, and they're sort of preparing of, if you're big enough, you're important enough to cause systemic problems, and then perhaps you're big enough to get saved or regulated or otherwise kind of brought in within the embrace of the Fed is the way I personally view it. It's my personal view.
I don't even know if this is a question, but, so we didn't mention this at the start of the show. Will's an attorney, right? And attorneys have to pass a character and fitness review, but Yellen didn't have to. And I'm not saying she wouldn't or couldn't, and you get these people that are just making these decisions as to what is systematically important. I get it. Okay, there are things, if you take sort of the definition of systematically important, I get it. You're going to bring the banking system down. You're going to cause the Fed to do things they don't want to do, however you want to state it. But I think the thing that people don't ever understand, I love your comment on this, is government is people. And there's a person there going, yeah, you can survive and you can't, just like you said, winners and losers. And I'm wondering where that ends, because it always favors the larger ones. The lockdown was the same thing. I just did a TV interview where we talked about the damages of the pandemic lockdown, and what companies were damaged and what companies succeeded. Do you feel there's any sort of a connection with that in terms of character and fitness, individuals making the decisions, or you'd like to see these things structurally? Go ahead, Jimmy.
By the way, you guys got to let me into this after Will says, because you guys are talking about it so nicely and not mentioning the nefarious notion that the government is systematically trying to create a national banking system. And that's why they have these, they keep whatever. Will, you answer the question, and then we'll have a little more fun after that.
Yeah, it's 2.5 hours if you need it, Will. Go ahead.
Yeah, so it's an interesting thing. So I mentioned this to a lot of people. So when you think of these institutions, you have to think of them in two ways. One is that they're tasked with a very large job, which is making these institutional decisions, and they don't want the entire system to fail. And I think that's a reasonable view. And then you also have to consider the fact that when they make these decisions, they come with their own individual view, which is effectively, I don't want to lose my job, or I don't want to look bad in this role.
Talk about the banks or the Fed right now? The banks or the regulators?
The regulators, really.
Got it. Okay.
So you think about like the Fed or Janet Yellen making these decisions, right? And then they also inevitably come with like a political background as well, of things that they're most comfortable with or their political ideologies, right? And so when they come into those roles, implicitly there's a statement being made about how they view a larger societal system. And so in Janet Yellen's case, and I think it's been true, if you had Janet Yellen on the show and I said this, I don't think she would probably disagree. She's always been kind of a proponent of bigger banking. I don't think she's ever created a policy position or made a statement such that she didn't support bigger banking or centralized banking. I think that's something she's perfectly comfortable with. And so, if you're in the private sector and you're looking around, you're saying, I don't really like that because there's less competition, or, if there's only 10 banks, how are the consumers supposed to have any kind of pull of any kind, or how are the banks even supposed to operate in a way that's effective or efficient? I think that's a reasonable view to take. I mean, it's more of a political ideology conversation about whether or not you support having a nationalized, like you're starting to say, if you're expecting to have, if you don't like having a nationalized banking system. From my personal view, I don't know that Janet would be so against that. Her view is sort of she's a bigger government person, I think, by nature. So I'm speculating as to her views, which is always a danger.
But you are personally against that. You believe a national banking system or 10 big banks, they could pressure them who to lend to, who not to lend to. They've already done that with lending to fossil fuel companies in the same week, trying to deny them access to credit markets and then turning around asking them why they're not pumping fuel, and then lining up all the big banks. Will you commit to not lending? And Jamie Dimon was like, no, it's stupid. So, I mean, there's something nefarious about this. Yes, I'm not trying to bring you down a rabbit hole any further, but it just seems relatively obvious.
Yeah, I don't know that I have enough insight to really determine if it's nefarious or it's just kind of a
stupidity.
Yeah, there's that saying, right? Where it's don't attribute to malice what you can attribute to incompetence. I'm not in a position to know the mens rea, the mindset that goes into these folks as they're doing what they're doing. But I think logically, if you just take a look, you take just a kind of overall view of this, and you say to yourself, well, the message from the global financial crisis was clearly, if you're big enough, we won't let you fail because we don't want to deal with the aftermath. And I think implicitly, if you're someone who is an operator who works in business, you say to yourself, that's inherently anti-competitive, right? Because if I do something bad, I effectively get saved, which is the exact opposite, really, of what you want in a capitalist society. You want to permit some failure so that someone new who's more innovative or has better risk controls will eat up that market share and come into that spot. And so it's sort of inherently an anti-competitive practice in a way. And so, if you there's that saying, you show me the incentive, I'll show you the outcome. And so if you incentivize a system that's based on that, it inevitably introduces moral hazard to it. And you see that. I mean, that's a constant conversation that goes on in the financial system where folks are like, well, if we all fail together, it's kind of like a bunch of fish in the net, right? If we all fail together, it's the government's problem. And Twitter's, ripe with that. You see that all the time. if you post anything on Twitter about that, everyone's just like, yeah, well, they can't let it fail. Equities go down, they can't let it fail. And so it's become sort of a catch-all, which I think is inherently, in my personal view, I don't think that's ideal for, society. And we're talking in sort of a grandiose term there. But you want to cap, I think, Jim, you're an entrepreneur, right? Like you have a restaurant or the like. Mm-hmm. And so same thing. Like that wouldn't, for your restaurant, that wouldn't make any sense. Like, let's say hypothetically your restaurant's doing great and everyone else in the neighborhood's doing terribly and you're eating up market share. And then the Fed just came in, and it's kind of a trivial example because it's a smaller industry. But say hypothetically, the Fed comes in, saves all those other restaurants. Like it's inherently anti-competitive thing.
Correct. Right.
Yeah. And so when you think about this in that situation, it seems almost trivial. It's like, of course, like why are you saving a restaurant that everyone hates the hamburger? But then, in banking, that's effectively, in a sense, what we're doing. So it's,
it's almost like they saved the Cheesecake Factory near Jimmy and they let everything else go because the Cheesecake Factory.
That's a better example because saving the big one. Yeah. And letting the little ones go. Yeah.
Well, can we talk about the Fed a little bit?
Sure. Yeah. And I was just going to mention before we switch topics that, I think the shadow banking system kind of needs it's worth talking about. And I think a lot of people don't fully understand kind of what's happening there because there's effectively a structure of funds that have started doing direct lending or stepping into a role that was traditionally a banking role. It's similar in a way to what's going on in regional banks. Like regional banks stepped into the commercial real estate market effectively because the big banks could not. And so, as the regional banks are failing, the private credit funds are basically saying, oh, this is like, this is a feast for us because now there's additional market share open as these banks fail. We can just step into it. And I think that creates an additional risk because now you're talking about, if you thought regional banks weren't regulated enough, private credit is, comparatively to that is effectively the Wild West. It's not regulated really at all. There are some regulations, but compared to a bank, it's not regulated in a material way. And, they're stepping into a lending role because there's this group of borrowers who are effectively underbanked. They need loans to continue their operations and they're giving them via funds. And that just creates sort of a new vulnerability in the system because when you look at private credit or these fund structures, even though they're doing a lending function, they're considered a non-bank. So they're not a bank, even though they're doing something that's very similar to banking. And they need a source of funds. You need money to lend on these loans, to lend these loans. And when they do that, effectively they source those funds from, the insurance, pension, foundations, endowments. And in some cases, they get a loan from a traditional bank. And so you kind of end up in that situation, like what a tangled web we weave here, right? We have a series of fund structures and everyone's kind of aware of the fact that it backs up into someone systemically important or someone who's been designated systemically important. But we also know those borrowers need loans. And so it becomes another one of those situations where, similar to the conversation we were just having a second ago, where you're saying, what are we prioritizing here? If we keep saving everything big, we end up with just kind of this like one portion of the industry is just like the only protected area, and we're just letting everything else fail, even though that's all inevitably part of the larger system. You can't avoid it in a sense. It's just being sort of swept under the rug. It's almost like a repressed memory in a way, or like repressed anger in a sense. It's like we all know it's there, but just no one's talking about it. If we don't look close enough, we'll worry about it when it happens, I think is sort of what's happening, which I think is dangerous. And I think people should, look at it and be more aware of it.
Well, let's do that then. Let's talk about that. I have a friend who's doing that in Chicago. Actually, he works in private credit and he works at a commercial real estate, for lack of a better phrase, a fund.
Yep.
And he about 3 months ago told me he's bailing banks out, right? Which I assume is exactly what you're saying here, right?
Yeah, that's basically.
I said to him, how is that going to work for you? He goes, I'm either going to be a billionaire or I'm going to be broke, which is kind of the unregulated cowboy mentality that you're talking about, or am I wrong?
No, that's exactly right. Yeah. So, it's always easiest when you think about these things that are more complicated to think about it as like its foundational unit. And you kind of hit the nail on the head, right? So you talk to your friend and he says, I'm in private credit and I wasn't really doing business in this space, perhaps. Now that the regional banks are failing and these commercial building can't get a loan, I'm willing to take that risk because, like you said, like if it works out, I'm going to be rich. And if it doesn't work out, I'm functionally broke. And you don't really want to market that's based on that kind of cavalier of an attitude, I don't think. And perhaps not all private credit funds are. Like there are certain ones that are already very, very large and perhaps they have better risk controls. But you create that appetite in the market and you create open market share, someone will fill it. It's like power abhors a vacuum, right? And so someone is going to step into that role to try to bank it. And the premise of the regulations that came out of the global financial crisis really to try to prevent risk by making sure everything was sort of in the light and everything was well capitalized. And there's really only a segment of the market where that's true. The rest of it has just moved off into a fund structure where no one's really paying attention to it. Yeah.
Bobby, you wanted to talk about the Fed, but a quick question: these shadow bankings and private lending institutions, where does the money come from? Just big investors?
Yeah, so it's a fund structure, right? So what you have basically is a GP will set up the fund, and then you have limited partners that'll come in, the LPs will come in. And so effectively, those sprung up in sort of a hunt for yield. So you think of like the balance sheet of a pension or the way an insurance company works. When they're taking in premium and they know that they're going to have to, they do an actuarial analysis and they know that they're going to have to pay out certain claims at a certain portion of the year. What they do is they go out into the world and they look for investments and they look to make a profit inevitably. So if they know that, say at 5%, every year at 5%, I'm going to have to pay out in terms of claims, they're going to go out into the environment and in the market, and they're going to look for 5% to match, 5% asset to match against that potential liability, right? You do basically like an asset liability match. And so historically, those businesses are extremely liquid because in a world where a sovereign bond or investment grade bond is yielding what it would normally, when I say normal, I mean in a non-ZIRP world. So say it would yield like 4 or 5% or something. That's a really easy business, right? And it's super liquid, and you pile your balance sheet full of highly liquid assets, and no one really is worried about that. The regulators check it for solvency, but they're not really worried about liquidity typically because it's investment grade paper, it's sovereign government bonds. Those are highly liquid markets most of the time. And so in a ZIRP world, basically what happened was it's sort of you think of it as being like a continuum of assets where you can buy that will make this asset liability match. And so in a world where a sovereign bond is 1% or 1.5%, you kind of force those decision makers to say, okay, well, I need to get more than that if I'm going to match my liabilities. And so when they go out into the world, they start looking at more exotic assets to buy. And so in many cases, that pushed that, which is a large portion of capital, pushed that capital into riskier investments. And so in some cases, kind of my long-winded answer of saying, in some cases, they push that money into fund structures. In some cases, they push that money all the way into VC as like a kicker. Some of them pushed it into private equity. Basically alternatives. They look to alternatives and for what's effectively a liquidity premium to kind of make up for that return they're missing from what they would have had in just a traditional portfolio of your high quality liquid assets. And in some cases, they actually kind of rent out their high quality liquid assets, which is always an interesting conversation too. But through sort of like a collateral transformation trade they make with securities brokers. So basically, there's ways of kind of gaming the system that are not within the spirit of the regulations that were intended by, Dodd-Frank and Basel and the various regulations that popped out of the global financial crisis, just by way of they need yield to maintain their businesses and to continue to run their business in an effective way. And so it sounds sort of nefarious when you think about it in the abstract, when in reality, when you think about it on like an individual level, just a decision maker, it starts to become a lot more logical where you're sitting in the room and you're looking around at your investment committee and you're like, well, we have 5% of claims we're gonna have to pay out this year. We got to find something. And so you look around and you say, well, the only place I can really get that return is if we devote some portion of the book to alternatives. And so when you do that, you introduce illiquidity risk and other risks and redemption risk from those funds. Yeah.
So let's take it to markets then. And again, I want everybody to know you're not like a stock picker or a market prognosticator, but how would the dominoes have to line up for what you've been talking about, especially the shadow banking part? Because I think that's wildly interesting. How would the dominoes have to line up to affect just equities in general, positively or negatively? Again, not a prediction, but
sure. Yeah. So I think when you look at the risk of those markets, what you're really worried about is liquidity risks. And so you kind of saw that already if you think back to the UK situation where they had with the LDI situation. Mm-hmm. So effectively what happens there is you have a bunch of pensions who have been using the derivatives to kind of have a little return kicker on their books with their high quality liquid assets. And so when the Bank of England decides that they're going to stop QE and introduce some volatility into those markets, those pensions basically have to de-risk. And so all the pensions basically at the same time decide that they need to de-risk. And when they do that, they basically flood their own, the gilt market effectively. And so they effectively make the gilt market go no bid. They break the gilt market because everyone's on the same side of the trade trying to sell as they unwind that derivative trade. And so what you saw there is Bank of England basically stepped back in and said, okay, here's the deal. We're going to do QE again for like a month, but that's it. Just unwind your trade so you get out of it. And then everyone goes back to being solvent. But you run into the risk where if you have a bunch of funds who have to all unwind the same trade at the same time, you can take a highly liquid market and make it illiquid very rapidly because you just have massive flows that are just all on the same side of the trade and no natural buyer. And that's sort of like a natural function of, you think of what quantitative easing is in a way, because you have a buyer that's a non-economic buyer in the government. They're buying for a policy reason, not for an economic reason. And that distorts prices across all markets, really, because all markets are functionally based on the risk-free rate of return. So they're all based on the treasury. Yeah, I'm in the US, so I'm always saying the treasury market, but they're all markets are functionally based on the return you can get risk-free from a treasury. And so when that market is changed or disturbed in any way, or volatility is introduced, it inevitably affects all markets across the curve, including equities. Because, if you think of equities and you say, I expect 7% return annually just on average, and that's just like, the long-term average of an equity. Why would I take that risk perhaps if I can get 5% on a 10-year treasury? I may not, because I can just lock in the return risk-free. And some of those institutions will change that risk. And so when you do that, it changes the flows and it changes the demand for equities, and that will inevitably alter prices to the extent that there's a premium in excess of the earnings that stocks are producing. And I think you see that now. I mean, I don't think it's not a prognostication, but I don't think it's particularly controversial to say that there's a very large premium for most stocks over the earnings. And that's to say the price to earnings ratios are pretty spread on most stocks that you look at out in the world. And that's largely just a function, in my view, of ZIRP and zero interest rate policies. That if
Bobby, can I ask Bobby a question real quick before I forget about it with this? Because on this show, we always talk about central banks. And we always use the expression, everybody's got a plan until they get punched in the face, the Mike Tyson thing. Back when you think about the Bank of England, was that about a year and a half ago where they flip-flopped like they did? That was a perfect example of that. And that's one of the reasons I believe that every central bank deep down, we haven't seen them get punched yet. And all of them have the potential to flip quickly, do they not?
I do think that. And I think part of the reason is the strength. Well, probably the main reason is strength in the stock market, right? I mean, there's all these things that are going on functionally, some of which Will just talked about. But when you look at how the stock market reacts right now, it's not necessarily to earnings. I'll give you an example. As of Monday, we had 81% of the S&P 500 that reported actual earnings for the third quarter, right? Of those companies, 82% of them reported EPS above estimates, which is above the 5-year average. The 5-year average is about 77%. Interestingly enough, the average of beats is 77%, which tells you they're not being fully honest. They're not trying to pinpoint their earnings estimates exactly when they put them out, right? So 82% has reported that beats the 5-year average. But when you look at it further, the companies that are reporting earnings, they're reporting 7.1% above the estimate. That's below the 5-year historical average, which is 8.5%. So the beats are smaller versus the 5-year average. The most interesting thing I found when I was looking at the stuff this morning, somewhere in the range of 5.2% of, I'm sorry, let me rephrase this. So when they miss earnings, the 5-year average 2 days prior and 2 days after is down 2.3%. Right now it's down 5.2%. So they're getting hit harder for missing than they ever have in the past. So there's underlying weakness. And I need to throw out there, as I said before we started talking, Jimmy, I'm bullish stocks right now. But it seems so hyper-focused on what the central banks do, which is why I find what Will is saying and why I asked the domino question so interesting. Because it still seems to me when I look past the Fed's done, we got to go higher narrative, you see the 2s, 10s inversion getting worse again. The future for equities just doesn't look that great to me, but I can't fight it.
Right.
Yeah, I think I was just going to say, just to mention on that, like if you separate prices from underlying earnings far enough, it does become a question of liquidity flows, right? And the biggest source of liquidity in the market is clearly the central banks. And so, it makes perfect sense what Bobby is saying, right? You can't really, it's that kind of the classic adage, like you can't fight the Fed and you can't fight it either way. So, if they're adding liquidity to a market, regardless of fundamentals make sense, you kind of have to follow along.
So,
and if they do the opposite, you have to be paying attention to that too. Yeah.
So to both of you guys then, feel free to jump in, whoever thinks it. If the Fed actually holds rates, let's say they don't move rates or QE, QT, that relationship, for 9-10 months, do stocks then continue to look to the Fed, kind of like your dog does around dinner time where he's looking for his food? Or do we actually start to go back to earnings or anything else? What do you think, Jimmy? And then
I'll take it first, and because my answer is going to be short, Will. Absolutely, they do. They need to get the candy. We saw that. And that the Halloween week, when those bullshit numbers came out, which call into question all the other economic data points, and all of a sudden the Fed funds curve started taking all the interest rate eases, all the hikes out, putting eases in, and the stocks loved it. So there's still a direct correlation, as Will said. Liquidity, the Fed liquidity is what stocks care about more than anything else. And if they kept rates 9 months at this level without budging, I think that would be very, very bad for risk assets. Will?
Yeah, I just follow along with that, and I'll just say that I think the Fed implicitly has the goal of creating a recession. I think that solves a lot of the problems that they have in their own world, and so I think that the market will react to that at some point because it's effectively the Fed telling you that we're going to cause low growth. And when you do that, same thing. You affect the price of things across the board, across markets. So I don't think that can be ignored forever. And so in the short term, you have these little kind of the 10-year backs off and you see like a liquidity flow come in basically because FCI loosens up a little bit. The financial conditions index loosens up a little bit. And I think that's fine. You have to, if you guys are traders, so I'll leave that to you. But practically speaking, sooner or later, that becomes an indication of a lack of growth. And I think sooner or later markets have this habit of it's sort of like when you're driving a car or something and you're driving too fast and you kind of look at your speedometer and you're kind of just like, it's probably wrong. And you kind of ignore for a while until the sirens go on, and then all of a sudden it's a big problem.
This is such a bad example with Bobby. Bobby, there's no such thing as too fast to him. He's like one of those Dagos who wears chains and drives a Trans Am. He's one of those people. Like
if they still had that flaming chicken, it would be in my driveway right now.
Right. Yeah. Okay, you just talked about something that I thought was interesting. We talked about the Fed, and I want to talk residential real estate because the most direct line between the rapidity of these Fed rate hikes was supposed to be breaking up the real estate market, particularly residential real estate. It didn't. Can you speak to that as to why it didn't and what the ramifications are going to be?
Sure. Yeah. I guess my personal view is that, these rate hikes have affected the most sensitive areas first, right? And you can kind of see it, how it kind of blew through the system, right? So it took VC out first because that was like our crypto really first. Then it hit VC. Then it kind of hit the commercial real estate, and it's starting to pressure PE and some private credit. And now it's sort of leaking through into like multifamily, what I would say. These are still investment classes of real estate, CRE, multifamily, but it's working its way through the system of who's the most leveraged, and it's working its way back towards housing. And so I think in a lot of ways, it's just a matter of time. Is that situation where there's like always beware the long and variable lags of the Fed. I think in a lot of ways, if we took a snapshot today, you might think like everything looks okay. But if you are following the way everything's connected and you look at the dominoes and look at the full chain, you can kind of see the early ones starting to fall over. And so you're kind of just waiting for it to connect down the chain. So I know a lot of people are like, oh, housing's fine still. There's always people in my feed. Anytime I make a comment about housing, a bunch of Twitter folks are like, oh, there's a supply shortage or whatever. But from my perspective, you're seeing demand already starting to fall out. I know like mortgage applications hit an all-time low, or like a low since the 90s earlier, and I think last month. And so you're starting to see those effects happen. It works its way through the system. First, it's applications, and then you'll start to see prices move. So it's just, it depends what you're looking at.
That's the interesting one, because the housing part, I read almost everything you post. And one of the housing things that I'm always looking at is new home builders cannot build enough to fill the gap of homeowners, number one. But number two, we have an entire generation of people who are simply so strapped by the deliberately generated inflation and the quick snap that we've gotten in it, that even if we end up having a glut of homes, if we can get mortgages down 2-3% from here, you're still not going to get refinances, but you could have a solid enough economy where people start to say, okay, I'm okay now. I got my debt down. I've reduced my spending. I can trade up a little bit or even trade down a little bit to make things manageable again. But man, if you pay attention to your feeds and anything you look at, and I'm not on much social media, the younger generation is basically saying they can't afford food. Now, I've only got a certain amount of sympathy for that, but that sympathy comes from the knowledge that this is generated inflation. It's not naturally economic occurring inflation. It's been deliberately generated. So I'm curious, when you look at housing, again, lay out the dominoes. How does it happen that housing prices actually start to collapse and starts to damage the homeowners beyond their refis?
Yeah, so I'm always kind of sensitive to the supply and demand argument, because if you print a bunch of money, that will create more demand, and you will have a supply shortage. And so you kind of saw that early with the Fed. So it's like the Fed prints a bunch of money during COVID. They turn around and they're like, oh, look, there's a supply shortage. We didn't do that. The supply shortage is causing problems for inflation. And then, 6 months or whatever go by, and then they're like, oh yeah, about that, we need to raise rates because actually maybe that was our bad. And so you kind of see that slow.
Yeah, that. I love that. About that.
Yeah, exactly. And that's what kind of happens, right? And you see that slow kind of drift down the slippery slope. And when I look at housing, I view kind of the same way. So you have a demand side and supply side to that. If you raise prices enough, people will just not be able to pay, right? If their incomes haven't increased relative to that. There's sort of three variables there. It's like most people in the US anyway, buy their homes with a mortgage. And so there's two relevant prices there. It's the price of the house physically and then the principal payment. And there's how much does the mortgage payment cost. And for most people, if they can gather the down payment, and some of I think Bobby said I'm not that sympathetic to, but if some people in my generation perhaps saying we can't even get the down payment, but assuming you can, when you're looking around, you're saying, can I afford this interest rate of my mortgage payment, which is functionally a interest rate cost? If you crank that up high enough, people will turn away from that. And so on the demand side, it's much more volatile, and I think in some ways by the Fed more controllable than the supply side. And so even if you have, I'm always a little bit facetious about it, 'cause like where the supply shortage people go now that housing prices are starting to like level off. But even if you have a supply situation, if you affect demand enough, that will cause prices to stall out, right? And you basically just end up with a big bid-ask spread that sort of freezes the market until someone makes a determination either way, where either salaries have to go up so people can actually afford these things, or the housing prices just come down so that people can afford these things, right? So you basically just create an affordability crisis. And you're seeing that now. I mean, folks who didn't get in earlier, they're kind of looking at these housing prices, I think, and the rates they're at and just kind of balking and just saying, yeah, I mean, you see that with, mortgage applications. So like people are just like, yeah, I can't do it. I'll just rent.
Can I ask two questions related to that too? You went through that and I liked a lot of it, but you didn't mention that you necessarily believe there is a systemic shortage of supply that stems from the great financial crisis. And you also didn't mention people hanging on to their 2.5% mortgages. And actually the real effective rate that people are paying on mortgages is much, much lower than, the 7%, 7.5% right now. Is the fact that everybody had time to roll into duration prior to the rate hikes, is that a big deal? And is there really a supply shortage that stems back from 2008?
I think in a way I'll take your second question first, which is, I think rolling forward your duration basically, or having an effective rate that's lower, I think it definitely affects in terms of like the lag. I don't know that it affects in terms of like prevention the way some folks seem to think. So that people are like, oh, if you locked in 2%, you don't care, you'll just wait it out. I don't think that's necessarily true. For one variable really is just keeping your job, right? And so if the Fed intends on kicking up the unemployment rate, if you lose your job, it doesn't matter if you locked in a 0% mortgage rate. If you can't pay your mortgage, you're going to have to move, right? Or you're going to default. So I think in one sense that you always have to look to that. From the kind of the other point of your questions, like the supply perspective, I'm always kind of hesitant. And again, it's just a personal view, so I don't read too much into it, but I'm always a little hesitant to look to a demographic argument when there's a stronger short-term argument in front of it. So I kind of, when I look at that, I even have a similar conversation when people talk about the government and like their ability to fund themselves, and they say there's a public debt problem. When I look at that, I always say, well, yeah, there is, but there's a larger private debt problem in front of it. And so I think in some ways housing is similar, where you say, well, yeah, like we can't build enough homes fast enough to house enough people who want it, but these people have to be able to pay for it first, right? And so if you have an affordability crisis, your supply shortage really isn't going to overcome that. In my view, I don't think so, unless some variable changes in terms of income or prices.
Bobby, I want you to ask the next question, but I do want like some takeaways. We talked about the KRE. We talked about like market-y takeaways too. I want to talk about some REITs and things like that if we can. But Bobby, what do you got?
Yeah, we have a question here, and I'm not sure that we can actually answer it because of the way the question is structured. Again, this is a live show, so if you guys have questions, you can go ahead and send them through. But it's, again, Metatron, I think you probably have to ask this in a more specific way. But the question says, what can the normal person do to protect themselves over the next 5 years? Condoms? I don't know what we're talking about. It's
no,
like,
I think I do. Don't you?
Yeah.
I mean, yeah.
I'm
if
not
we're
belittling, I just don't. Treasuries. What? Go ahead, Jimmy.
No, so I mean, I think it's a great question, and I think when I look at the next 5 years, of course, I want to have certain exposure to stock too, because I don't think it's a totally a lost cause, but not as much as I normally do, because I think the next 5 years will be difficult, juxtaposed against higher rates. I think when I look at things I want to actually own, I would own 2-year treasuries, I would own gold, I would own. I can't say real estate, maybe vacant real estate like Bob Stein had said, but I do think there's a potential for the federal government to accelerate spending when they should be decelerating spending and causing a bit of a crisis is too big a word. So let's just call it a debt mess and a currency mess. So I think you want to be in stuff that will rally that. Will, do you like that answer, or do you have another one?
Yeah, I mean, I think the questions like this are hard because it always depends on your personal financial situation and what your risk
Great point.
tolerances are. But I think when you look at these things, it helps to have kind of a contextual frame. And so if you say to yourself, what kind of return do I need personally for a certain time period, say like the next 5 years or whatever, and you look at what options you have available, and in a way, it's not different from the way that a pension will look at the world. And so you say, I could get a 2-year treasury risk-free for 5%. So that's pretty attractive if you're worried about taking on additional risk or you're afraid of the risk in equities. You could say, maybe you can even look at longer end of the curve and say, look at a 10-year and say, perhaps that's interesting to me because I'm willing to take a little bit of duration risk. So I think it's mostly a question of folks taking an honest look at what kind of risks they're willing to take. And if you graft onto that a environment where you could potentially have some kind of tail event, how protected do I feel comfortable needing to be? And so you're saying, Jim, you're saying, well, for me personally, some equities seem fine to me, and that's your personal view. And I think that's fine. I think that's especially depending on when you bought them and how confident you are in them as a individual holding. I think that's fine. But it's those decisions are always very personal because you have to look at kind of your own risk tolerances and what you're worried about. But it helps to contextualize those inside of the larger macro. There's always that thing where folks are like, well, if I bought a good stock, I'll just hold it forever. And I think that's fine, but you do also need to be aware of like the environment you're in, the contextual environment you're in. Macro, it makes all boats rise, and the water siphons out altogether too. So it helps to be aware. And
what I meant by maybe the question needs to be more specific is, Metatron, are you 72? With like a 7-figure retirement, 2 years, 2-year notes. Just leave it at that.
Yeah.
Are you 40 and you're worried? I go to gold. Gold is my thing. I'm not 40, but I look at the market in sort of 4 stages. This is my own way of looking at it. The early part of a recovery, reflation, which I would argue we're just coming out of, stagflation, which I would argue is a possibility, and deflation, right? And in 3 of those 4, real estate's in the top 5 performers when you go back and look historically. So I think, as a general question, I would say, given what I think of the markets, I'd say gold and real estate, but it just has so much to do with who this person asking the question is that I'm almost uncomfortable asking it. There's actually another question here directly for Will from Fresh Young Chris. And Will, you could take this question however it needs to be answered.
Sure.
The question is, ask Will about the Fed making the same mistake it made in 1929. Is this something you tweeted maybe, and this person knows you?
It is, yeah. It's something I tweet about fairly frequently. And so when I look at the Fed, I think of the Fed as being kind of wedged within kind of 2 former Feds. And so they're wedged between the decision-making of being like an Arthur Burnsian Fed, and you hear this kind of ideological debate happen in the financial news media and on Twitter, where folks say, oh, well, we can move the inflation target, then everything's fine. And I think if you do that, you run into like an Arthur Bernstein situation where you risk inflation becoming unhinged. And on the kind of the opposite side, what's different, I think, from my perspective, from like the 60s or really the 70s, which is kind of what folks immediately run to whenever they think of an inflation surge, because that's just like the most recent one. The debt load in the US and globally, I think, and a lot of markets, I think, are much more fragile than they were in the 1970s. I think the aggregate debt load private debt load is just a lot higher. And so I think you have to look back further, and it looks much more, it's always dangerous to say like 1929 because everyone like their brains explode because they're like, it's the Great Depression, right. Freaks out. But if you're looking for an analogy, I think it looks much more 1929-ish in terms of the risk. You have, and I think Dr. Burry actually might have tweeted something out similar. It's like the Fed's sort of torn between being a 1960s Fed and being like a 1930s Fed. And either of those things are like pretty bad. It's just a question of how bad and in which way you're bad. And when I look at it, the world, that's kind of what I see as what the Fed is wedged between. They're sort of wedged between a rock and a hard place. They don't really have a good way to land the proverbial plane. They want to, they keep saying, oh, soft landing. But from my perspective, I just don't see how. I think, if you stay the course and you tighten things up, you're already seeing kind of your rate sensitive folks already kind of crying out and saying, we can't take it. We're going to break. Everything's going to break. We're going to default on a bunch of debt. It's going to be a big default wave. And there are certain countries in the world that are vulnerable. Like if you think out to like Australia or Canada, they effectively both are primed for like poking a pin into housing bubbles, right? And so even though in the US it might not seem so bad, in other areas of the world it does. And when I look back at the 1920s, 30s, not really 1929, 1930s-ish range, what effectively happened was the Fed they hiked the rates really to about 6%, the discount rate. And even though it didn't immediately affect the US, it defaulted a lot of the world. So it defaulted like the emerging markets, it defaulted Western Europe. And then that lack of growth bleeds back. And I think in some ways you can see that happening today, where the Fed has hiked the rates up. It's called Triffin's dilemma, effectively. The domestic policy and the global policies have diverged. And so as the Fed has hiked up the rates in the US, being the reserve currency, it tightens the rest of the world involuntarily. And you see that sort of, China's real estate markets blowing up. Canada and Australia look increasingly vulnerable. A bunch of emerging markets have had currency crises and other issues. And you've seen, effectively, you've seen two wars break out effectively over commodity and resource scarcity. And so when you see those things starting to happen, you start to say to yourself, these are considerable risks that the Fed probably needs to consider and look at. And they don't really, in my view at least, they don't really have a good option, right? And domestically, they kind of have to stay the course. So they don't really have too much of a choice in a way domestically, but they make that choice for the whole world when they do it.
There's another question, Jimmy, in here that I want to ask before we run out of time. Many Donuts is asking, God, I love that. He just made me damn hungry. So avoid emerging markets over the next few years. I know my answer to that. Go ahead, Will.
Yeah, so this is always sort of interesting. So when markets sell off, people always think they're cheap. And sometimes something that looks cheap can get cheaper just because it's like a bad environment. And so you kind of see that now. You see like the Russell's kind of selling off. And that's really, in my view, a sign in this part of a market cycle is a sign that growth is starting to fall out. And perhaps the larger companies haven't felt that yet. Again, just a personal view, not a market prognostication or anything like that.
Right.
I feel similarly about EM in a way. Is that EM has sort of a dynamic where it gets heavily invested by developing countries during boom times or when during expansionary phases, and during contractionary phases, protectionism kind of clams up and a lot of liquidity flow out of those countries. And so just because it looks cheap, I know you'll hear a bunch of people, I'm sure I've seen some on financial news already where they're like, oh, small caps are cheap now or EM is cheap now. I think that's always a risky thing to just because something is cheap to buy it. You have to know why it's cheap, really. And I think towards the end of it, again, it's a personal view, but towards the end of a business cycle, you always have to be able to think a little concerned about that. I don't know if you gentlemen have different view.
No. If anyone wants to know my view too, they can go back to the Brent Johnson interview that Bobby and I did, and Brent goes into it in great detail. I assume you're familiar with him, Will, right? Santiago Capital is his Twitter.
He's the dollar milkshake man, right?
Bingo, he's a dollar milk.
Yeah.
I wonder if he's getting sick of that shit because everybody calls him the
He
dollar
branded himself
milkshake.
too well, and never escape it now. Yeah.
Yeah, but I do think he almost believes that we're, weaponizing the treasury market and weaponizing the currency, like almost intentionally. I'm not sure I believe that, but I do think that that a lot of those things are going to be sucking wind. And then, but a little bit of a tease, we had just talked to Tavi Costa, who is an excellent analyst, and his speech in the New Orleans Investment Conference was Brazil and the advantages they have and why he thinks that that's a place to put your money. I didn't hear all of it because I was busy at the time. But when we have him on the show, I'd love for him to make that argument. But let's wrap it here. Is that cool?
Yeah, just let me say this real quick. I think if you're one of those people, I completely agree with Will said about things that are cheap get cheaper. Oftentimes, when you look at things, when something makes a new low, it's somewhere in the range of 80% of the time. The next day it makes another new low. It takes a while for things to turn, right? When things are moving lower, they're going to continue to move lower. But if you were going to look at bottom feeding on an ETF, I would do it ex-China. Just because if you're gonna do it with China, then I would just go US personally, because as much as those two hate each other, I think they're linked. I think they're inexorably linked in the future as in terms of economic stability, but I could be wrong about that.
Well, you got any last words? Any hair care product tips? Any way I can look as good as you and as young as you? How old are you, by the way? Are you in your 30s still?
I am, yeah, early 30s. Yep.
Oh yeah, no, I turned 40 next summer.
Yeah, right.
No, I don't. I turned 60 in 2 summers. Right? Yeah.
You look good.
Thank you. I appreciate it. That's what I was fishing for, because I was going for that. But thank you so much, Will.
I'm in my 30s as well, so
yes, of course. But it was great talking to you. I'm really impressed. Thank you very much for coming on. This has been awesome.
No, my pleasure. Yeah, happy. If you guys have questions, just feel free to hit me on Twitter. I'm there frequently. So
I haven't seen your Twitter stuff in quite a while, and I've been following you a long time. Correct? Do you put out stuff frequently or no?
Yeah, pretty frequently. Yeah. So I think Bobby probably he's seen me probably harassing everyone in the feed, but I'm pretty active there.
Because I wonder if sometimes they lead you to certain people, because I don't remember seeing your stuff for a while, but I'll be looking for it a lot more closely now.
Shadow banned him as you're concerned, Joey.
That could have been, and that's at Will _ De Cottis. That's 2 I's, correct?
Yep, that's right. It's just my name, and if feel free if you have questions, feel free to DM me. I try to answer everyone I can. So
sure. Okay, cool. Well, thank you very much. That's it.
Good talking to you, buddy.
Likewise, guys. Thanks.